This lecture is over financial statement and ratio analysis. I'm your professor, Dr. Stephen Haggard. As financial analysts or financial managers, many times we need to be able to make comparisons between companies and between time periods for the same company. But this can be problematic, especially if the company has grown quite a bit since the last period, or if we're comparing to another company that is much larger or much smaller than us. For example, it would not make sense to compare the net income of a very small company to the net income of a very large company, or to compare the assets of a very large company to that of a small or medium-sized enterprise.
I'd like to share an example with you from my time in industry. The last company that I worked for was called Americam Incorporated in Cuyahoga Falls, Ohio, and we manufactured cooler concentrates for the plastic industry. Your typical plastic bottle would be clear if it wasn't for the addition of some sort of coloring agent. And a lot of times products require protection from UV light and such, and we were able to provide that through these cooler concentrates. Now, we needed to be able to compare ourselves versus a competitor, and fortunately across town in Akron, Ohio, there was a large company publicly traded called Poly One. And because Poly One was publicly traded, we could get our hands on their financial statements for comparison purposes. Now, would it have made sense for us to have compared our net income versus their net income? Absolutely not, because their company was many times larger than ours. Similarly, it would not have made any sense for us to compare our inventory to their inventory, because certainly a much larger company would have to have a much greater amount of inventory. So how do we reconcile these things? Well, this brings us to our next topic, common size financial statements.
One way we can compare companies on an apples-to-apples basis is to standardize the balance sheet and the income statement to create common size financial statements. On the balance sheet, what we'll do is take every number on that sheet and divide by total assets. That gives us every account as a percentage of total assets. On the income statement, we will divide all the accounts by total sales, and therefore have all of our accounts on the income statement as a percentage of total sales. Now, sometimes the income statement will say things like total revenues or something similar. So the best rule of thumb here is disregard whatever the name of the top line of the income statement is and use that as your divisor to come up with this common size income statement. Common size statement analysis allows us to compare companies, but it doesn't give us all the information that we really need to be able to facilitate good comparisons across many different measures. And so now we're going to get into something called financial ratio analysis. The problem is this: common size statements, the balance sheet, the stuff is only divided by total assets, and on the income statement our numbers are only divided by total sales. So those will be the only ratios that that kind of analysis produces. If we have a ratio or a need to measure something that's divided by something other than total assets or something other than total sales, then we need to come up with some additional ratios. These ratios can be very important for assessing a firm's performance and its liquidity and several other aspects, so they're important for us to know and to take a look at. Why are they interesting? Well, they can be used for competitive analysis if we want to compare our firm to a competitor, which is very important. They could be used for internal analysis to determine what the trend is in performance or in a financial situation of the firm. And they can be used for external analysis. Now, what's external analysis? That's when people outside the company are taking a look at the company to make perhaps investment decisions. Equity analysts will be looking at our firm to determine whether or not they will recommend that their clients buy our stock. Suppliers will be looking at our firm to determine whether or not they should extend us credit when they're selling us items. Banks will be looking at our firm to determine whether or not to loan money to us, and bondholders will be looking at our firm to determine whether or not they are interested in buying our bonds.
The first family of these measures we are going to discuss are the short-term solvency or liquidity measures. Recall that liquidity is the ability to turn an asset into cash at or near the full market value in a short amount of time. And so what we are going to look at here is the ability of the company to produce cash to meet its short-term obligations. Our first measure from this family is the current ratio, which is simply current assets divided by current liabilities. Recall that current assets are the things we expect to turn into cash over the next year, and current liabilities are the things we expect to require cash over the next year. Thus, the definition of short term in finance means less than 1 year. Now, a current ratio of greater than 1 indicates that we will have enough money to pay off all our bills over the next year, assuming that all of the current assets turn into cash. But that's not always a safe assumption. For example, inventory is part of current assets, but it doesn't always turn into cash. When I worked at Halliburton, we had a pump that had not been manufactured since 1957, yet we kept spare parts on the shelf. And the only place on the planet that pump was being used at the time was in Vietnam. And at the time there was a trade embargo against Vietnam, and we could not ship those parts there. And so basically those parts were not going to sell. That inventory was not going to turn into cash within the next year. In order to overcome this problem, we can calculate something called the quick ratio, or acid test. And to calculate the quick ratio, all we do is subtract out inventory from current assets and divide by current liabilities. If the quick ratio is greater than 1, that means that we can pay our bills over the next year even if we don't sell another single item from inventory. Sometimes that's not conservative enough for people, and they want to be even more conservative and figure something called the cash ratio. Recall that the current assets are typically made up of cash, accounts receivable, inventory, and then some minor other stuff. If we don't sell any inventory, and if we don't collect a single dollar of our accounts receivable, then we're left depending on our cash to pay our bills. If the cash ratio is greater than 1, that means we'll be able to pay all of our bills over the next year without selling another piece of inventory or collecting a single dollar from our accounts receivable. Typically, healthy companies, don't have cash ratios greater than 1 because they do have the ability to collect accounts receivable, and they know they're going to sell at least part of their inventory. And having excess cash on your books is not a good way to create shareholder value. So who cares about these measures? Well, how about short-term creditors like suppliers? For instance, suppliers sell us items based on credit terms of 30, 60, or 90 days. Do they care if we're going to be in business 5 to 10 years from now? No, they only care that we're going to be in business long enough to pay our bill. And so these short-term solvency or liquidity measures are perfect measures for these folks to use. And then there are people who buy our commercial paper in the public debt market. Commercial paper is like a very short-term bond that has no coupons. It's 270 days maturity or less. And so if you have an instrument that matures in less than 270 days, these measures that examine our solvency over the next year would work perfectly well. And finally, banks may loan us money on short term, and so they might also be interested in the short-term solvency or liquidity measures.
Next, we'll talk about the long-term solvency measures. These look at the firm's ability to pay its bills beyond 1 year for the most part. We'll see that definitely the first 3 fall into that category. The other thing I want to tell you about the first 3 is that they are very much going to differ by industry. Firms will be able to handle a different amount of debt in their capital structure based on their business model. If they have a business model that brings in steady cash flows on a constant basis, then it will be fine for them to have a higher amount of debt. However, if they have very unsteady cash flows, it would be dangerous for a firm to have a lot of debt. Here's why. Picture 2 people. Both of them make $100,000 per year. One of them makes that amount every year in a monthly paycheck. In other words, they get the same amount of money every month. The other person is selling vacation rentals in Branson, and they do a great business in the spring and summer, but in the fall and winter it's especially horrible. Now, which one of them has steadier cash flows? Definitely the person receiving the monthly paycheck. that person could have a much higher amount of debt because their cash flows are much more steady. However, think about the person with the unsteady cash flows. During good times, they would be able to easily make their debt payments. But during bad times, they might not have enough income to make those payments. So such a person, unless they were very disciplined, which most Americans are not, such a person should rely very little on debt and mostly on equity. Firms are the same way. Think about city utilities, our utilities provider here in Springfield. They have very steady cash flows because all of us like to have our lights on. We like to be able to take a shower and use the toilet. We also like to have heat in the wintertime and to be cool in the summer, so we're willing to pay our utility bill even when we don't have money to pay other bills. And so city utilities has very steady cash flow. As a result, city utilities can run with a much higher amount of debt in their capital structure than the average industrial corporation, and definitely more than, say, biotechnology firms. What do the cash flows of biotechnology firms look like? Well, they lose money on pretty much a constant basis until they manage to come up with something great, which they sell for a huge amount of money, so they have very, very uneven cash flows. The same can be said about a lot of technology firms. You'll see such firms having very little debt in their capital structure. So let's take a look at these measurements. The first is the total debt ratio. And we'll first define that as total assets minus total equity, that amount divided by total assets. Now you may say, wait a minute, where is total debt in all of that? Well, in truth, total assets minus total equity is equal to total debt. And over on the right-hand side, you can see that we have total debt over total assets. The reason that we write it out this way is because sometimes people get confused and they only include the long-term debt in the total debt ratio. Taking total assets minus total equity makes sure that we pick up the short-term debts as well. Total debt ratio is just the percentage of the assets that are funded with debt. And it, in fact, is my favorite long-term solvency ratio because it's a straight percentage. But if you get to debt to equity ratio, things get a little different. Once again, we represent total debt with total assets minus total equity, or you can throw in total debt if you can handle that. But it's all divided by total equity. So let's think about a firm that has a total debt ratio of 0.5. That means that 50% of the assets are funded with debt. That same firm would have a debt-to-equity ratio of 1. So how did I know that the debt-to-equity ratio would have to be 1? Well, the firm's capital structure is composed of debt and equity. If 50% of the capital structure is debt, by definition, 50% has to be equity. So 0.5 divided by 0.5 is going to be equal to 1. Now, here's my problem with the debt-to-equity ratio. As debt increases, you get a linear response out of the total debt ratio, but you get a nonlinear response out of the debt-to-equity ratio. Let me demonstrate. If the total debt ratio went from 0.5 to 0.6, that's a 20% increase. And we throw those same numbers into the debt-to-equity ratio. In that case, with 0.6, we would wind up with 0.6 divided by 0.4, which gives us 1.5 for the debt-to-equity ratio. Now keep in mind that the total debt ratio only went up by 20% from 0.5 to 0.6, but the debt-to-equity ratio went up by 50%. Therefore, there's this non-linear response of debt-to-equity ratio to changes in the amount of debt in the capital structure. And I don't like that personally as a mathematician and a mechanical engineer. On the other hand, I have to teach you debt-to-equity ratio because you will find lots of people talking about it, especially equity analysts if you watch CNBC or Bloomberg. So it's a term you need to be familiar with. Then we have the equity multiplier, which is just total assets divided by total equity. And this is really a measure of financial leverage. And we'll talk about what financial leverage is in a bit. Now here's the really fun thing. You can also get the equity multiplier by just adding 1 to the debt-to-equity multiplier. Why is that? Well, total assets is just equal to TE plus TD. So if we replaced total assets with TD plus TE, the TD over TE would remain the same. The TE over TE would cancel out and become 1. That's why the equity multiplier is also equal to 1 plus the debt to equity ratio. So if I give you a problem where you need the equity multiplier, but I've given you the debt to equity ratio, it's really easy. You just take 1 plus the debt to equity ratio. Now, you want to know what is a good number for these? And the answer is it depends on the industry. And so what you want to do is look at other firms in your industry. If you are close to the average of the other firms in your industry, you're probably in good shape. If you have way higher total debt ratio or debt to equity ratio or equity multiplier, then you might have a problem and you might need to issue some new equity to pay down some debt to get your total debt ratio and such back into line with the industry. We say there is not a capital structure that is optimum for every firm, but within industries there appear to be optimum capital structures for firms in that industry because the cash flows within the industry often have the same amount of volatility or, for lack of a better term, riskiness. Okay, let's talk about times interest earned and the cash coverage ratio. Times interest earned is how many times over can I pay the interest I owe using EBIT or EBIT, depending on how you want to pronounce it. Remember, that's earnings before interest and taxes. Why are we interested in earnings before interest and taxes? Well, for one thing, we definitely want to do earnings before interest because we're going to be paying the interest out of it. So we haven't paid the interest yet, what we're looking at here. And taxes, if my interest is high enough that it wipes out if my interest is high enough, what if my EBIT was exactly equal to interest? How much taxes would I owe? The answer is 0 because interest is tax deductible. So anyway, that's why we look at EBIT. But there's a problem. EBIT still has depreciation in it. And remember, depreciation is a non-cash expense. And so we have the cash coverage ratio where we add back depreciation. So which one of these is more conservative? Definitely times interest earned because it doesn't add back depreciation. As a lender to a company, which would I rather see? A higher times interest earned or a lower times interest earned? Well, higher, of course. Would you rather loan $10,000 to a person that made $10,000 per year or one that made $100,000 per year? The second individual would have a much higher times interest earned and would be a much better credit risk. So who cares about these measures? Well, long-term creditors. Long-term means anything greater than a year. These would be bond holders. If you buy a 10, 20, or 30-year bond from the company, you would be a long-term creditor. If you were a bank loaning on a 5 to 10-year time frame, then you would be a long-term creditor. And to some extent, I think you would be interested as an equity analyst or as an equity investor. Because if the firm goes bankrupt, equity takes a tremendous bath. And the reason that is true is because equity is a residual claim. Shareholders only get the residual, what's left over after the debt holders are paid off. If you can't pay off your debt holders, then you're definitely not going to have anything left over for your equity holders. Okay, let's talk about another family of measurements. We'll talk about asset management or turnover measures. And the first one we'll talk about is called inventory turnover, and we're going to measure it in something called turns. It's actually unitless. And we're going to find it by dividing cost of goods sold by the amount of inventory that we have. Both of these are going to be in dollars, so the dollars are going to cancel out. Now, why are we measuring our sales in terms of cost of goods sold instead of in terms of sales? It turns out that cost of goods sold and inventory are both recorded at cost, and so this gives us an apples to apples comparison. What's good for inventory turnover? Well, the higher the better most of the time. You can get to a situation where inventory turns are so high you're keeping so little in inventory that you might be missing some sales, and as a result you might be missing out on some profit. Days sales in inventory we can calculate as 365 divided by inventory turns. Why 365? This is the number of days per year. Inventory turns is basically times per year, and so the per year cancels out and we end up with days sales in inventory being expressed in days. Let's do a quick example. What if we had 1,200 cost of goods sold and 100 in inventory? Our inventory turnover would be 12 turns. How many days sales would we have in inventory? We'll take 365, divide by 12, and you'll come out with something slightly greater than 30 days. That makes perfect sense. Why? If the inventory is turning over 12 times per year, that means on average it's turning over once per month. Something a little more than 30 days sounds a whole lot like a month to me. Next we'll talk about receivables turnover. We also measure this in turns, and it's a measure of how much in sales are you producing given your accounts receivable. What we do is we take sales from the income statement and divide by accounts receivable from the balance sheet. Now, why didn't we use cost of goods sold here? Well, it turns out that sales and accounts receivable are both recorded in terms of the price we charge our customer. So you can think of these as being recorded at retail and the inventory and cost of goods sold as being recorded at wholesale. Either way, in order to be apples to apples, we have to compare sales to accounts receivable. And this is going to give us something called turns, just like we saw for inventory. What's better? Typically, higher is better. But if you might get to a point where your credit was so stingy that you were actually losing customers because of your unwillingness to finance their purchases, and that can lead to lost sales and lost profit. So there is such a thing as having receivables turnover that is potentially too high. Days sales in receivables is calculated as 365 divided by receivables turns. This is very similar to days sales in inventory. And a way you can think about this is the number of days on average that our customers are taking to pay. Now, what's good for these numbers? Well, it really kind of depends on the industry. If you're in a business where you're doing highly specialized items that have to be on the shelf for immediate use, for instance, if you were stocking spare parts for nuclear plants, you might have very low inventory turnover and that would be okay. On the other hand, if you're a supermarket, your inventory turnover should be very high. For one thing, bananas don't last forever on the shelf. They go bad, and most groceries are that way. Secondly, the margin on groceries is very low. You're making 2 to 3% profit on groceries, which means you need to push a lot of them through your store to show a good profit and be able to support the building and the staff and whatnot. And so we really say you need to look at the industry. Compare yourselves to the industry here. If you're slightly better than the industry, you're doing good. If you're a whole lot better than the industry, you might start questioning whether you were keeping too little in inventory or being too stingy with your accounts receivable. Now, day sales and receivables really can be interpreted as the number of days your customers are taking to pay their bills. If I tell you that there are 59 days sales in receivables, is that a good number or a bad number? Well, it turns out that it depends on your credit terms. If you give your customers 60 days to pay and you've got 59 days sales in receivables, you're actually doing okay. But what if you've been telling your customers they need to pay in 30 days and you've got 59 days sales in receivables? That's not good. It means you've got a lot of late payers. The next turnover ratio is total asset turnover, and it's just sales divided by total assets. The idea here is that you are measuring how well you are utilizing your assets to produce sales. Typically, the higher the better. However, you might find yourself in a similar situation like we saw with inventory and accounts receivable, that you're keeping your assets too low and therefore you are limiting your sales. My example here is Hyundai. Hyundai right now is selling every car it can make. There's a waiting list to purchase Hyundais because they're really good cars at a really great price. Now, what if they were to build another plant? Their total assets would go up. Their sales divided by total assets might not go up as much, but their sales over total assets might actually decrease. But with those extra sales, we might pick up a lot of extra profit. And so you could find yourself in a situation where your total asset turnover was very high, and you might actually do better if it were a little lower. Now, who cares about these measures? Well, first of all, firm managers concerned about performance. When I was in manufacturing, I was held accountable for my inventory turns, and so I was very conscious of that. The credit department was held very accountable for receivables turns and day sales and receivable. And of course, our CEO was kept accountable for total asset turnover. Who else might care? Well, how about equity analysts and competitors? First of all, equity analysts usually are looking at several companies within the same industry, and they need means to compare these companies to each other. And these are good performance management measurements. And competitors also want to be able to benchmark themselves against other people in the industry. Remember earlier I said you want to figure these things for your competitors and compare yourself, and if you're doing a little bit better than the average, then you're probably doing okay. Well, that is where competitors come in. We want to look at our competitors' numbers and see how they're doing.
I'd like to give you a couple of real-world examples about managing receivables. I was visiting with a former CFO of a company that later on became a Fortune 500 company. In fact, many of you would recognize the name if I said it. But back when he started with this firm, it was actually small and struggling. And he was in charge of paying bills. Now, a lot of times, you can use the credit extended to you by your suppliers as an interest-free loan. And this is actually in your best interest to do so, because otherwise you might have to borrow money on interest from a bank to replace those funds. And so what he did was to receive the invoices in from his suppliers, and then he would type up a check for each bill. And he would place that check in his desk drawer. And he would wait. He would wait until the phone rang, the supplier asking to be paid, which of course would happen after the credit terms have been expired. In other words, after the 30, 60, 90 days that the creditors had given them to pay. And so he was able to, in that way, basically get longer-term interest-free loans from his suppliers. In all the years that he did this, only one supplier actually figured it out. A steel supplier would call him on the 31st day after the invoice had been issued and request payment. All the other vendors remained blissfully ignorant of this and would basically only call him after 60 or 90 days. Now, the second example has to do with a company that I worked for, Halliburton. When I first got my job at Halliburton, I went to see my cousin Ray, who's kind of a mentor to me, and he owned a trucking company. And when I told him I was going to work for Halliburton, he says, "Halliburton's great." I said, "How so?" He said, "They pay off like a slot machine." I said, "What do you mean?" He says, "I send them a check, I send them an invoice, and within 3 or 4 days I'll have a check, even though I've told them they've got 30 days to pay." Was Halliburton being efficient in how they were handling this? Absolutely not. Halliburton should have been waiting until the last possible moment to pay, therefore making use of this basically interest-free loan from my cousin Ray's trucking company. Now, an interesting point of fact, when I got to Halliburton, I was hired by new management that was trying to shake up the company, and one of the very first things they did was to stop paying bills until the very last moment before they were due, and it was actually quite financially advantageous to the company to do so. And my third example about managing receivables has to do with a local business I was doing some pro bono consulting for. Pro bono means free. This was in the summer of 2008 when the world was falling down around us, and lots of people were in financial straits. And this company was supplying a service, and their customers typically paid on time. But I could tell by the graph on their wall that their days in receivables had been climbing since the economic troubles had started. And I pointed this out to the people and I asked, do you view your customers as friends? And they said, how do you know? Yes, how do you know? And I said, because you aren't calling them up and asking them to pay. And they said, well, no, we don't. And I told them that they needed to, as soon as an account went late, they needed to pick up the phone and call and ask to be paid, because as my grandmother would say, the squeaky wheel gets the grease. And then of course someone brings up the fact that the customers are their friends. And I told them that personally I already had enough friends. What I need are paying customers.
Next, we're going to look at measures of profitability. The first is called profit margin, and it's simply net income divided by sales. Now keep in mind that sales on your income statement may say something like total revenue, but don't worry, just take the top line from the income statement. Now profit margins are going to vary by industry. Once again, for the grocery market industry, you're going to be looking at low profit margins, and for companies like Intel and for Cisco, you'll be looking at high profit margins. Then there's a measure called EBITDA margin. Now EBITDA is just EBIT, but it also does not have depreciation and amortization in it. In other words, they take EBIT and add back depreciation and add back amortization. Now, why do they add those things back? Well, they're non-cash expenses. And so that's actually kind of a measure of operating profit. We can divide that by sales. Now, that should be higher than profit margin because profit margin has interest subtracted out, it has taxes subtracted out, depreciation and amortization also subtracted out. Then we have return on assets, which is a measure of how much profit are you creating given your assets, and it's net income divided by total assets. And we also have return on equity. Now keep in mind, assets are funded by both debt and equity. And so your measure of return on assets is really independent of your capital structure. However, return on equity will be higher for firms with lower amounts of equity given the same amount of assets. And I'll show you a little bit more about that here in a minute. Now, who cares about these measures? Well, first of all, firm managers concerned about performance. My last employer in industry, our bonuses were based on return on assets. Now, it's very important that they base it on return on assets instead of return on equity, but I'll show you why that's the case here momentarily. And secondly, equity analysts and competitors. All of these things are ways to compare companies in the same industry. Of course, you wouldn't want to compare across industry because optimum values or good values for these will be different from industry to industry. Now we move on to market value measures. And the first thing that I want to talk about is earnings per share. Basically, this is just taking the net income earned by the firm and dividing by shares outstanding. Now, there's nothing intrinsically good or bad about having a lot of shares outstanding. You could have two identical companies, one with 100,000 shares outstanding and one with 1,000,000 shares outstanding. And there would be nothing bad or good about either one of those things. But it does change earnings per share. So what I'm telling you is you can't compare company to company based on earnings per share because it could simply be an artifact of a different number of shares outstanding. So this is more accurately a measure that we should be comparing period to period for the same firm, assuming the number of shares outstanding remains constant. Next, we'll talk about price to earnings. Basically, this is usually called PE ratio, and it's just the price per share divided by the earnings per share, which we just calculated. Where do I get price per share? Well, that's a stock quote. You can get that on Yahoo Finance or from the Wall Street Journal, any number of places. That's just the price of the firm's shares on the market. You can think of PE ratio as being what people are willing to pay for a dollar of earnings. Typically, we see the PE ratio for the S&P 500 being somewhere around 14, perhaps sometimes as high as 20 something, depending on how things are going in the market. But it's the price per share, the price that people are willing to pay for a dollar of future earnings. Now, why are people willing to pay more for a dollar of earnings from some companies than they are from others? The simple answer is growth, but we'll show you the derivation of that later in the semester. Next, let's talk about market to book ratio. And that's just the market value of the equity divided by the book value of the equity. How do I find the market value of the equity? I just take the number of shares outstanding multiplied by the price per share and divide it by the book value of the equity. What's the book value of the equity? It's simply the assets of the firm minus all the liabilities. What would a good market to book ratio look like? Well, Warren Buffett says if a company has a lower than 1 market to book ratio, it's like giving the managers $1 and expecting them to turn it into something less. This is not a particularly good scenario. So the higher the market to book ratio means the higher the value that the market places on the operation versus what it has on the books. It's possible to buy a firm, a distressed firm that has a very low market to book ratio, fire the current management, recapitalize the firm, and turn it into a successful firm, but that's not anything that typically the small investor is able to do. Then we have market capitalization, and that's just the price per share times the number of shares outstanding. This is the market value of the equity as discussed above. We also talk about enterprise value. That's going to be the market capitalization, which is the market value of equity, plus the market value of the interest-bearing debt, and then we're going to subtract out cash. Why do we subtract out cash? Because it's really not a part of the value of the enterprise, meaning the value of the operations. For example, right now, Apple, at the time of this recording, Apple has at least $50 billion in cash.
The cash on a firm's books that is not necessary for operations should either be invested in positive net present value projects, in other words, ones which will increase shareholder wealth, or return to the shareholders.
That cash could easily be paid out as a dividend, and what would be left over would be this enterprise value. And then sometimes people like to calculate enterprise value multiples, and the most common one is EV divided by EBITDA. Because we're talking about enterprise value here, that's the value of the ongoing operations, and the EBITDA is basically your gross income from those operations. And so a higher multiple here would be similar to a higher PE ratio. It would indicate that people expected greater growth out of that firm. I want to leave you with some final thoughts on these ratio comparisons. First of all, you should only compare ratios between firms in the same industry because these ratios can be markedly different for firms in different industries and with good reason. Even within the same industry, you may still see differences based on the business model. For example, Home Depot and Ace Hardware are ostensibly in the same business. However, they have very different business models. When you walk into Home Depot, typically what you see on the shelves are lots of items that lots of people buy on a regular basis. Compare that to Ace Hardware. They have lots of different items, but they're very specialized items typically, and they may not sell them very often. They also tend to have better trained people working in the hardware store, and so you can walk in and describe your problem, and not only will they be able to point you toward a product, they might be able to tell you how to install it, and the product that they point you toward may have been sitting on that shelf for 3 or 4 months. Home Depot would never allow that because they have a totally different business model. Now, would it be right to compare inventory turns between Home Depot and Ace Hardware? Absolutely not. Ace's business model requires basically a lower inventory turnover. On the other hand, we would expect Ace Hardware's profit margin to be higher because not only are they selling a product here, they're also selling a service with the expertise that goes along with it. So those lower inventory turns might not be so bad a deal because the profit margin on the products they do sell are higher. Also, you can't always apply a bigger or smaller is better mentality to ratio. For example, liquidity ratios. Current ratio is very low. That's a bad deal. If it's, say, 1/2, that's a very bad deal. Now, a current ratio of 1.5 might be considered healthy. Would that mean that a current ratio of 3 would be even better? Perhaps not. Let's take Apple, for instance. Apple right now has $50 billion in cash on its balance sheet. That makes all of Apple's liquidity ratios look very, very good. Does that mean that shareholders are happy? Absolutely not, because that money could be put to work either designing and building new products, or it can be paid out to the shareholders as a dividend. So we have to be careful with the idea that bigger or smaller is better on these ratios. There's always kind of a nice place to be, and then the extremes tend to be problematic.